There's a signal flashing red right now that has appeared before every major economic catastrophe of the last century. A signal so reliable, so consistent, that when it activates, entire fortunes vanish within months. Not years, months. This signal predicted the Great Depression when millions lost everything they owned. It warned of the dot-com collapse that wiped out trillions in wealth. It screamed before the housing crisis that destroyed the global financial system. And right now, in 2025, this signal isn't just flashing. It's blazing like a wildfire, deeper and more intense than anything we've witnessed before. What makes this moment different isn't just the intensity of the warning, it's the scale of what's at stake. The global economy today is built on more debt, more leverage, and more interconnected risk than has ever existed in human history. When this system breaks, and the signal says it will, the collapse won't just echo 1929. It will make 1929 look like a minor correction. You see, most people think economic crashes happen randomly. They believe markets just suddenly decide to fall apart, that recessions appear out of nowhere like natural disasters. But that's not how it works. Every major collapse follows a pattern, a sequence of events as predictable as sunrise. The wealthy know this pattern. The institutions know this pattern. They're already positioning themselves for what's coming, while everyone else remains completely blind to the approaching storm. The signal I'm talking about has a name. Financial professionals call it the yield curve inversion, but that technical term doesn't capture what it really represents. It's the moment when the bond market, the most conservative and cautious part of the financial world, starts screaming that something is fundamentally broken. It's when investors become so terrified of the immediate future that they'd rather lock their money away for 10 years than risk lending it for 6 months. Think about what that means. Imagine being so afraid of what's coming next week that you'd rather make a deal for the next decade. That's the level of fear we're seeing right now. And history tells us exactly what happens next. In 1928, this signal appeared just as the Roaring Twenties reached their peak. Everyone was getting rich in the stock market. People were buying everything on credit. The newspapers were filled with stories of permanent prosperity and endless growth. Sound familiar? The signal inverted, and for almost 2 years, nothing happened. Stocks kept climbing. People kept celebrating. Then October 1929 arrived, and the world changed forever. The same pattern repeated in 2000. The internet had revolutionized everything. Technology stocks were soaring to impossible heights. Everyone believed we'd entered a new era where old economic rules no longer applied. The yield curve inverted in early 2000, warning that the system was under stress. But the party continued for months. Then the dot-com bubble burst, wiping out $5 trillion in market value. Again, in 2006, the signal flashed red. Housing prices were climbing endlessly. Banks were lending to anyone with a pulse. Financial experts assured us that real estate could only go up. The curve inverted, but everyone ignored it because the economy looked invincible. Employment was strong, profits were growing, confidence was sky high. Then 2008 happened, and the entire global financial system nearly collapsed. Now here's what should absolutely terrify you. Today's inversion isn't just similar to those previous warnings. It's deeper, longer, and more extreme than anything we've seen before. The yield curve has stayed inverted for longer than most people alive have ever witnessed. Yet just like every time before, the surface looks calm. Markets are rallying. Unemployment appears low. Politicians and financial media keep telling us everything is fine. But that's exactly what makes this moment so dangerous. The calm before the storm isn't peaceful because there's no storm coming. It's peaceful because the storm is still building, gathering strength, preparing to unleash devastation that will reshape everything. What's different this time is the foundation underneath our entire economic system. In 1929, most people didn't have debt. In 2008, the crisis was mostly contained to housing. But today, debt is everywhere. Government debt has exploded to levels that would have been unimaginable just decades ago. Corporate debt has reached record highs. Household debt from mortgages, student loans, credit cards, and auto loans has never been higher. The entire system runs on borrowed money, and when borrowing costs stay elevated, something has to break. Here's the mathematics that everyone wants to ignore. When a family borrows more than they can afford, they eventually have to stop spending or default. When a business refinances debt at double the previous rate, they eventually have to cut costs or close down. When a government owes more than it can ever realistically repay, it eventually has to print money or face collapse. These aren't political opinions. These are mathematical certainties. The yield curve inversion is showing us the exact point where this mathematics stops working. It's revealing the moment when the cost of carrying all this debt becomes impossible to sustain. And unlike previous crashes that were contained to specific sectors or regions, this collapse will be global because everything is connected through the same debt web. Banks around the world hold government bonds from multiple countries. Pension funds have invested retirement savings in corporate debt that may never be repaid. Insurance companies have promised payouts based on returns from investments that are already underwater. When one major institution fails, the shock will spread instantly across continents because everyone owes money to everyone else. But here's what makes the situation even more precarious. The people in charge of managing this crisis are using the same playbook that created the problem in the first place. Central banks keep printing more money. Governments keep borrowing more than they earn. Financial institutions keep taking bigger risks with other people's money. They're not solving the underlying issues. They're making them worse while hoping the system holds together just a little bit longer. The irony is that the longer they delay the inevitable, the more catastrophic the final collapse becomes. Every month, they prop up the illusion of stability. More debt gets piled onto an already unstable foundation. More promises get made that can't be kept. More people get drawn into investments they don't understand, based on assumptions that have no basis in reality. We're living through the final act of the greatest financial experiment in human history. For the first time ever, every major economy on Earth is running on pure fiat currency, backed by nothing but confidence and promises. There's no gold standard, no hard assets, no real constraints on how much money can be created or how much debt can be accumulated. It's all based on collective belief that the system will continue functioning. But belief is fragile. Confidence can evaporate overnight. And when it does, when enough people start questioning whether these promises can actually be kept, the entire structure comes crashing down faster than anyone expects. The yield curve is telling us we're approaching that moment of collective realization. What happens next won't just be another recession that we recover from in a few years. It will be a complete reset of how money works, how governments function, and how ordinary people survive. The institutions that seem permanent today will vanish. The currencies that feel stable will become worthless. The investments that appear safe will evaporate. This isn't speculation or fear-mongering. This is pattern recognition based on centuries of documented history. The mathematics of debt cannot be suspended indefinitely, and the yield curve is showing us exactly when the suspension ends. Consider what's happening right now beneath the surface, while everyone celebrates market highs and low unemployment numbers. Corporate bankruptcies are quietly rising across every sector. Small businesses are closing their doors because they can't refinance debt at affordable rates. Credit card delinquencies are climbing as families struggle to keep up with payments. Consumer spending is shifting from wants to needs as discretionary income disappears. These aren't headline stories because they're happening gradually, one business at a time, one family at a time. But they're the individual threads being pulled from a fabric that's already under tremendous stress. When enough threads get pulled, the entire fabric tears apart instantly. The housing market provides a perfect example of this hidden deterioration. Mortgage rates have more than doubled from their pandemic lows. but home prices haven't adjusted accordingly. This means millions of homeowners are trapped in properties they couldn't afford to buy today at current rates. They can't sell because they'd lose money. They can't refinance because rates are too high. They're stuck making payments on assets that are functionally worth less than what they owe. Commercial real estate faces an even worse situation. Office buildings that seemed valuable just 3 years ago now sit half empty as remote work becomes permanent. The owners still owe the same mortgages, but the rental income has collapsed. Banks that lent against these properties are staring at massive losses they haven't yet acknowledged. When they finally mark these loans to realistic values, the banking system will face a crisis that makes 2008 look manageable. The stock market continues climbing despite all these warning signs because there's literally nowhere else for money to go. Interest rates on savings accounts remain below inflation, so cash loses value. Government bonds pay almost nothing after accounting for currency debasement. Real estate is overpriced and illiquid. Commodities are volatile and difficult for ordinary investors to access. So money flows into stocks by default. Not because companies are fundamentally worth these prices, but because everything else offers guaranteed losses. This creates the illusion of a healthy market when it's actually a desperate flight from currency debasement. Everyone is buying stocks not because they want to, but because they have to. That's not sustainable market behavior. That's panic disguised as optimism. Meanwhile, the currency itself faces unprecedented challenges. The dollar's status as the global reserve currency has allowed America to export its inflation to other countries for decades. When the Federal Reserve prints money, the world absorbs those dollars through international trade and foreign exchange reserves. But that absorption capacity is reaching its limits. Countries around the world are actively building alternatives to dollar-based trade. China and Russia conduct massive transactions in their own currencies. The BRICS nations are developing payment systems that bypass American banks entirely. Central banks globally are buying gold at rates not seen since the 1970s. They're preparing for a world where the dollar is no longer dominant. When that transition accelerates, and it will, trillions of dollars currently held overseas will come flooding back to America. The inflation we've experienced so far will seem mild compared to what happens when the global demand for dollars collapses. Prices will rise so fast that wages won't be able to keep pace. Savings will evaporate. Fixed incomes will become poverty incomes. The middle class will disappear almost overnight. This is why the yield curve inversion matters so much. It's not just predicting a recession. It's warning of a complete monetary reset that will divide society into those who own real assets and those who don't. The wealthy understand this. They're already converting their paper wealth into physical assets, land, precious metals, energy resources, anything tangible that will retain value when currencies fail. The average person remains completely unprepared for what's coming. They're holding their wealth in bank accounts that pay interest rates below inflation. They're invested in retirement funds that own overvalued stocks and worthless bonds. They're carrying debt with variable interest rates that will become unpayable as rates rise. They're planning for a future based on assumptions that are about to be shattered. Education systems don't teach financial history. Media outlets don't explain how monetary systems actually work. Politicians promise solutions that violate basic economic laws. So most people enter this crisis completely blind to what's happening and why. They'll be told it's temporary, that recovery is just around the corner, that government intervention will fix everything. But governments can't print prosperity. They can only redistribute wealth from those who have it to those who don't, until there's nothing left to redistribute. The yield curve is showing us the timeline for this redistribution to accelerate beyond control. Every day it stays inverted. Every week that passes without addressing the underlying debt crisis. Every month that central banks continue printing money to fund government spending. The eventual collapse becomes more severe and more sudden. History teaches us that these transitions happen faster than anyone expects. The Soviet Union went from superpower to non-existence in less than 3 years. The German hyperinflation destroyed a century of savings in 18 months. The Great Depression turned prosperity into poverty in a matter of weeks for millions of families. When confidence breaks, when the collective belief in the system finally cracks, there's no gradual decline. There's immediate collapse followed by years of rebuilding on completely different foundations. The people who survive and thrive are those who recognize the pattern before it completes and position themselves accordingly. The yield curve has given us the warning. The mathematics of debt has shown us the timeline. The only question remaining is whether enough people will pay attention to prepare for what's coming, or whether they'll continue believing in illusions until reality forces them to face the truth. The pattern is accelerating, and the signs are becoming impossible to ignore for anyone willing to look beyond the carefully crafted narratives being sold to the public. While mainstream financial media continue spinning stories about soft landings and resilient economies, the real economy underneath is cracking like ice on a warming lake. You can hear it if you listen carefully. The sounds of a system under stress. Small regional banks are quietly tightening lending standards to levels not seen since 2008. They're not announcing this in press releases or quarterly earnings calls. They're simply saying no to loan applications that would have been approved automatically just 2 years ago. Business owners seeking working capital are being told their credit profiles need improvement. Families applying for mortgages are discovering that their debt-to-income ratios, which were acceptable last year, are now problematic. This credit contraction is happening in slow motion, invisible to most observers because each individual rejection seems reasonable and isolated. But when you aggregate thousands of these decisions across hundreds of institutions, you're witnessing the early stages of a credit freeze. Money isn't flowing to where it's needed because lenders have finally started asking the question they should have been asking all along. What happens if this borrower can't pay us back? The answer to that question is becoming increasingly obvious. Default rates are climbing across every category of debt. Auto loans, credit cards, commercial mortgages, student loans. The increases are still being described as manageable by industry experts. But manageable compared to what? Compared to the artificial stability created by years of emergency monetary policy that made borrowing essentially free. When money costs nothing to borrow, almost everyone can make their payments. When interest rates double or triple, which is exactly what's happened, the mathematics change completely. A business that could easily service debt at 3% interest suddenly faces bankruptcy at 7%. A homeowner whose adjustable rate mortgage was affordable at 4% discovers their payment has doubled at 8%. These aren't hypothetical scenarios. They're happening right now to millions of borrowers who thought they understood the terms of their agreements. The fine print that everyone ignored during the years of cheap money is now the most important text in their financial lives. Variable rates that seemed like minor details are now determining whether families keep their homes or lose everything. The yield curve inversion is measuring this transition from artificial stability to mathematical reality. It's showing us the precise moment when the cost of carrying debt becomes higher than the economic benefit that debt was supposed to create. A company that borrowed money to expand operations discovers that the interest payments exceed the profits from the expansion. A government that issued bonds to fund social programs realizes the debt service costs more than the programs themselves. This is the debt trap in action. Not the theoretical version discussed in economics textbooks, but the real-world version that destroys societies. Once you're caught in it, every solution makes the problem worse. You can't pay down the debt because you need the borrowed money to function. You can't default because that destroys your ability to borrow in the future. You can only keep borrowing more at higher rates until the mathematics become impossible. The United States government is demonstrating this trap in real time. Interest payments on the national debt now exceed defense spending. Think about what that means. More tax revenue goes to paying bondholders than to maintaining the military that supposedly protects the country. And those interest payments are accelerating as old cheap debt gets refinanced at current, much higher rates. Every government bond that matures has to be replaced with a new bond at today's interest rates. The Treasury isn't paying off debt. It's rolling it over at whatever rate the market demands. As confidence in government finances erodes, those rates climb higher. Each new bond issue costs more than the last one, creating a spiral that ends only in default or currency collapse. But governments can't default the way businesses or individuals do. They have a printing press. They can create money to pay their debts, which is exactly what they're doing. The Federal Reserve creates dollars to buy treasury bonds, enabling the government to spend money it doesn't have. The European Central Bank does the same thing with euros. The Bank of Japan prints yen to fund government operations. Every major economy is running on manufactured money. The yield curve has spoken. History has warned us. Mathematics has shown us the inevitable outcome. The only choice left is whether you'll be among those who saw it coming and prepared, or among those who believed the comfortable lies until reality shattered their world. The greatest economic collapse in human history isn't approaching anymore. It's here.